So here you have a bearish big shadow in June. Okay, so I just want to go over a few of the rules for this webinar to jump into a trade here. Now, I want to jump into a trade just. Hello traders, my name is Chris Laurie and I am a commodity trading advisor with Seaview Capital. Seaview Capital is also my company and we trade on behalf of private and institutional clients throughout the world. And I just wanted to introduce myself because I will be sharing your desktop with you for a period of at least 24 hours, assuming that you finish the course. And it is a very, very comprehensive course, which I congratulate you on taking on and furthering your education in the foreign exchange environment, because it is my belief that your number one tool in trading will be the more thorough your understanding of the market, then the more trading opportunities you will have and the more strategies you will be able to employ and the more opportunities that you'll be able to have in extracting money from the foreign exchange market. So I congratulate you. And what I wanted to do is I just wanted to introduce myself and share a little bit about my story and tell you just sort of how I evolved as a trader in this market, and maybe just tell you a little bit about, of course, some of my beginnings. I grew up in a family of 8 kids, and I grew up in the city of Windsor, Ontario, Canada, which is an automotive town, and my father worked in the automotive industry.
Hey, what's up? Hey, if this other person don't show up, then we'll go over. I'll show the video on price action, and we'll do some stuff on price action and support and resistance. Um, but if they show up, then I'll do a different video. I'm gonna do a different video because they're kind of brand spanking new. So, oh, okay. Well, you didn't watch any of the green room videos? All right. All right. Well, we'll go over. I'll start from the beginning then. All right. All right.
What is that?
Hey, Nugget.
I have my baby. Have my baby. It's raining, Daddy. It's raining.
Mm-hmm.
We haven't.
Nugget, go start you some bath water.
My bath.
Mm-hmm.
Yuck.
No.
Hey, Dad.
Mm-hmm. Go start your bath water.
Okay. Hey, that's you, Dad.
Cam, you starting your bath water.
You gonna take a bath?
Uh-huh.
Mark, he ain't got nothing plugged up. The water just going straight through.
Oh.
Did you put the stopper in there? He's good. I told him they better sit down and put that junk in the ground.
Oh, yeah. That's funny.
All right. Go start your water.
Alright.
Hello traders, my name is Chris Laurie and I am a commodity trading advisor with Seaview Capital. Seaview Capital is also my company and we trade on behalf of private and institutional clients throughout the world. And I just wanted to introduce myself because I'll be sharing your test top with you for a period of at least 24 hours, assuming that you finish the course. And it is a very, very comprehensive course, which I congratulate you on your education in the foreign exchange environment, because it is my belief that your #1 tool in trading will be the more thorough your understanding of the market, and the more trading opportunities you will have, the more strategies you will be able to employ, and the more opportunities that you'll be able to have in extracting money from the foreign exchange market. So I congratulate you. And what I wanted to do is I just wanted to introduce myself and share a little bit about my story and tell you just sort of how I evolved as a trader in this market, and maybe just tell you a little bit about, of course, some of my beginnings. I grew up in a family of 8 kids, and I grew up in the city of Windsor, Ontario, Canada, which is an automotive town, and my father worked in the automotive industry basically all his life. He kind of lived the American dream, and we really did have, it really was an enjoyable family environment. But what was interesting was this, and what I really appreciated about my dad and my parents, my upbringing, was this, is that when we were growing up, actually, we basically were led or taught to open a bank account from the time that we were very, very little. And of course, if you open a bank account, you have to have money to put in the bank account. And we never received any allowance of any kind in the household. In fact, we were just encouraged to go out and to earn the monies on our own. So what my dad would do was, he said, he would, before the age where it became mandatory for us to have a job, what my dad did was he said, okay, look, so at the time we were growing up, like literally before we were 10 years old, or 10, 12 years old, if we wanted something, let's say a bike or something like that, depending upon how old we would have to finance a certain percentage of the bike. So in order to finance a certain percentage of the bike, then we, of course, had to have an income. Now, we were not paid for any work that we did around the house, so we had to, of course, generate our income from somewhere else. Now, my father, of course, encouraged entrepreneurship, and he would encourage us to, or feed us with ideas as to how we could generate some income by either going down the street and asking the neighbor if they needed a certain type of work done on their house or around their house, or some menial chore. But basically, what it did was it trained us to, #1, have an entrepreneurial sort of entrepreneurial spirit or mindset, as well as an appreciation for the process of planning and initiating activity where you can generate money, but also holding your savings and treating your money properly and investing it properly. So we were allowed to spend a certain amount, and for what was it we wanted, we had to finance a certain percentage of it, or all of it, depending upon how old we were. But as well, we had to save some as well. So then, of course, we got to a certain age where we had to actually we had to have a job. We weren't allowed to hang around the house. So that was interesting. But I obviously, as you know, I have a sport background, and I was so involved in sport when I was growing up that we had this paper route that kept being handed down throughout the family. And interestingly enough, by the time it got to me, I was so busy doing sports that I did a poor job at the paper route, and I got fired. But in any event, as you know, I went on in sport, and I ended up competing internationally on the Canadian track and field team. I competed internationally for a couple of years, and then I did track a couple of years, and then just focused on the sport of bobsledding. And I actually thought that I was going to end my sporting career after my first Olympic Games. Then I decided to go on, and then a couple of years after my first Olympic Games, we became overall World Cup champions, which was probably a bit of a surprise to me. It happened a bit sooner in my career than I had anticipated. But once we became overall World Cup champions, I ended up doing 3 more Olympic Games after that. And when you're an Olympic athlete, it is your career. It requires just obviously intensive focus and absolute the most utmost of discipline. And of course, being in a sport that also has equipment, of course, as in the sport of bobsledding, and we have a lot of equipment uh, that we have to attend to and create. And so that, of course, in and of itself was a job, and there's a lot of other aspects to the whole team aspects, the equipment, the training, the nutrition, so forth. So really learned discipline in that environment, as well as the a lot of psychological challenges as you work your way to being one of the best in your field, and some of the psychological challenges in and around various racing scenarios and high level performance environments like the Olympic Games. Now, all the while when I was competing in sport, I was also, of course, I had attended school and I graduated Welcome, traders. I just want to quickly walk through with you how to proceed through this course with Chris Laurie and AllStarFX.com. You should have your manual and your CDs in front of you. First of all, this course is presented to you with a very user-friendly manual and CD-ROM menu with clearly noted sections and submenu items, as well as, of course, the detailed manual. Now, the slides in the manual will correspond directly with the slides that are shown in the theory and the sample sections of the CD-ROM. So you use your manual to follow along with the PowerPoint slides on the CD-ROM so you can make notes on what is being taught, various market scenarios as I walk through a traded scenario. Now, you will want to closely observe the live trading scenarios because ultimately it is the live trading scenarios that integrate all of the tools, because I don't want you to have a fixed opinion or a fixed valuation on any specific tool. That's why the integration of the the showing of the live trades will show you clearly how to integrate the tools, because, for example, one trade scenario may call for more emphasis to be placed on one tool versus another, while in another different trading environment, it may call for more emphasis on a different tool or aspect of trading than the other where there was previously more emphasis placed. So please look at the live trades and get a clear understanding of how to integrate the tools into the live trading environment. Now, there will be very little dialogue on trading psychology in this CD course. Please read my ebook titled Face the Trader Within in order to gain some insight on trading psychology. And as well, in the live workshops, I do get into trading psychology into considerable detail as well. Now, once you have gone through the course, it is important that you, after you've gone through the course, of course, you want to apply the various tools and so forth in your demo account. Some of you are probably already trading live as well. Then go through the course a second time. Although much of it may seem redundant, you will pick up on little idiosyncrasies that will be extremely important to your trading. So please go through the course a second time, or at least certain sections of the course a second time, because often what I've done through the course is there are certain things that are very important that I may not have repeated in order with respect to redundancy, and so I may not have repeated it too much. Therefore, if you go back, you will hear certain aspects that are very important that you'll see much more clearly the second time around.
Okay, I'm going to go ahead and I'm going to play the next video. We shouldn't be here no longer than until about 10 o'clock. Also, for those of you guys that are new, I think it's only a couple of people on the call today, but I can go over with you on how to set up your Thinkorswim account and how to set up a demo account. All this is free, no cost to you or whatever. Yeah, I'm gonna go into the next one really fast because I think I'm being called away.
What? The corner's gonna go up on this one.
Hello, traders. This is Chris Laurie, Commodity Trading Advisor. Welcome to the Pro Traders Club. And it's a pleasure for me to really have the opportunity here to share. Hello, traders. This is Chris Laurie, Commodity Trading Advisor. Welcome to the Pro Traders Club. And it's a pleasure for me to really have the opportunity here to share my extensive experience in this industry. I have been through a lot in this industry, and of course have managed funds. I have educated quite extensively in the past several years, and of course been doing some international consulting as well. It really is a pleasure of mine to be able to share my knowledge and experience in this industry with you guys. And let's just get started with this. We are going to go through a very extensive and detailed educational program. At the early stages, it may seem somewhat straightforward, but I do want to say that we will get into a great amount of detail as we proceed through this lesson. And probably the first thing that I want to say to you folks is that the number one factor in being successful in not only trading foreign exchange, but in any trading business, is to understand the market and to understand the market well. That will be your most effective tool when trading in the foreign exchange market, is just to understand the market. So what we're going to do is, as we proceed through these slides and these lessons and the simulated trading scenarios, I'm going to offer a lot of information on simply to the point of helping you understand the market and some of the idiosyncrasies of the market. All right, and let's get started. Your work is you, and don't let you down. This is a business, and I expect you to treat it as a business. Do not be flippant about the business, and I encourage you to treat this as a serious business, because you could do very, very well in this business if you treat it properly. It is a generous market and a generous business, which I love, and do not let yourself down. We're going to start out with some basics in the foreign exchange market, some very basics, before we proceed into some of the more significant or impactful information. In the foreign exchange market, we have both the spot market and the cash market. The spot market, of course, is when we talk about the spot market, or the spot price. The spot price is the bid price at which the banks are dealing in the foreign exchange market at that time. The spot price is the price. Let's put it this way: when you go to, let's say, a bank and you want to exchange U.S. dollars for some other currency, let's say Canadian dollars, and you have $100 and you want to exchange it for Canadian dollars, well, what's going to happen is there's going to be a exchange rate, and the exchange rate, there's going to be a spot price, and say the spot price is 1-to-1. Then what will happen is the banks or the large institutions or the dealers will put in a cushion on either side between the bid and the ask spread. So they will buy at one price and sell at another price. And the differential between those two could be as much as 5 cents, 6 cents, 7 cents, or even a lot more, as I've seen it recently. Now, 1 cent, of course, represents 100 pips, which we'll get into in a moment. But the spot market, when we trade in the interbank market, we actually trade on 3 100ths, 2 or 3 or 4 100ths of a cent in the spot market. And so that is where the interbank and the largest volume of transactions are taking place, and that is in the spot market. We also have, of course, the cash market, and the cash market can simply be viewed as cash transactions, cash transactions being dealt in and around spot price. And the cash market, of course, is simply if you have X amount of dollars, whether it's for you personally or for your business and so forth, and you want to actually make an exchange in cash for another currency that will be delivered to you. Okay, and there are some well over 4,500 world banks and financial institutions that are involved in daily transactions, and I want you to think about it this way. Think about, on a global level, all of the businesses that exist, all of the government entities and private enterprise, and of course personal consumption that exists on a global level. in each region of the world. And each of these regions, of course, do business with not only interregionally, but with regions in other parts of the world. And so what it requires from them is often you'll have a large business, as an example, and the business will need to make a transaction, whether it's with one of their subsidiaries or one of their a counterparty or a partner or of course a counterparty, as I mentioned, and they'll need to do a transaction where they may require funds in another currency. Therefore, it will require of them to make a large transaction from the currency that they currently are accustomed to dealing in into the currency that is required to bring the transaction to completion. And these transactions can move, can of course be 50 million, 100 million, 500 million, a billion, or $5 billion, or even more. And I've seen considerable transactions come through the data feed and through the news feed that move the markets significantly, namely some of those from the Bank of Japan. But nonetheless, if you think about it, this is where all of the volume is generated, and that the large financial institutions will make transactions from one entity to another. They do not deal through a central exchange, but they'll only deal from one firm to another to complete the transaction or to accommodate the transaction. Therefore, it is very difficult for any single entity to trace the amount of volume that is generated within one day, with the exception of the survey from the Bank for International Settlements, which we'll discuss in a moment. Of the three major markets in the world, the foreign exchange market quite simply dwarfs all other markets, which, based on the 2004 Bank for International Settlements survey, $1.88 trillion moves in a day, which dwarfs the U.S. Treasury bond market, which itself is enormous, and of course the U.S. stock market, which is much, much smaller. Foreign exchange market is greater than all other markets combined. Foreign exchange transactions occur over a 24-hour period. They effectively trade nonstop throughout the day, with the exception of light trading, very, very light trading, on a Saturday and part of a Sunday. The Asian session typically will go from 0 hours, 0-100 hours to 900 hours GMT, and then the European session will open at 700 hours and go to 1700 hours GMT, approximately. Of course, we see this overlap between 700 hours and 900 hours, which means that there is the largest amount of volume will be generated between these times. The U.S. session will go from 1,300 hours to approximately 2,200 hours. And again, we see an overlap from 1,300 hours to 1,700 hours. And again, the largest amount of volume that is generated within these overlapping periods. What that means to you as a trader is that you'll see the largest amount of volatility during these periods, and of course volume generated during these periods. These times are all approximate because, of course, Tokyo merges with Hong Kong and Singapore, and they're on somewhat slightly different time zones, and they all merge, and they all kind of have a little bit of different opening times. If you think about it, when these people, when these traders go to work, they'll arrive at work at varying times within a specific approximate starting time period. And again, Frankfurt merges with London, opens an hour before London, so often we'll see some volatility before the open of London, and the Central European session. The highest amount of volume and volatility, of course, occurs during the overlapping of the two sessions. This just gives you a bit of an idea of the time scale. If you go to the time where you live, for example, if you live in New York or in the Eastern Daylight Time, and you want to know what time the Asian session opens in your time of day, it is at 8 o'clock in the evening, which is, of course, the previous day, Asia is starting a new day. The European Open will happen at 2 a.m., while the London Open is at 3 a.m. Eastern Daylight Time. And the New York Open is at 8 o'clock a.m. And importantly, the U.S. economic figures largely come out at 8:30 a.m. So make a note of this, because this can be a nice reference tool for you for determining which markets are opening at what time relative to where you live. The Forex retail market evolution, just to give you a bit of a background as to how the foreign exchange retail market has evolved. I want to say that if you are trading through an off-exchange brokerage firm in the, that accommodates dealing for the retail trader, you're a retail trader. If you're sitting at your home trading through one of these off-exchange platforms, you are what's called a retail trader. In the early days, customers used to trade through banks with either approved credit or with no margin. And what you did was you took $1 million, typically as a minimum, and you would place it with a bank, and the bank would run a credit check on you and then seek credit approval to see that you are a fiscally responsible, and that they'd be willing to accommodate or facilitate your transactions. And they may or may not give you margin, but you can take that $1 million, you can trade in the foreign exchange market, and they may or may not give you margin or leverage on your funds, and then you typically deal by phone. And you would deal at a negotiated price. So you would agree on a dealing spread. At that time, in the earlier stages, they didn't have live feeds like we do today. So therefore, you had to go based on a price quote given to you by the dealer, and the dealer may have you as a buyer on one end and a seller on the other end, and he may account or build in a considerable spread for themselves when making a deal with you at the quoted spot price. So there was great advantages at that time to being a dealer in the interbank environment. If you were taking on a position trade, you would take cash delivery. So if you're exchanging US dollars for, at the time, Deutschmark, Swiss francs, or even now euros, you would actually effectively, or you could effectively take cash delivery on the transaction if you were to hold it for 2 or 3 days or longer when you would settle. Otherwise, you could open your position and close it within the same day, and you would not take delivery. Dealing in the interbank environment is also called on-exchange dealing. So you're actually dealing through the bank, dealing with an entity that is counterparty to other large institutions, and you're dealing, therefore your dealing was called on-exchange dealing. Then with the development of communications facilities, computers, internet, dealing software, and so forth, that all brought in the these what are called off-exchange or off-exchange dealing brokerage firms. These dealing brokerage firms are what are called FCMs, Futures Commissions Merchants. They are registered with the CFTC, members of the National Futures Association, or at least they should be, or registered in whatever jurisdiction it is that you live or are dealing through, whether it's the FSA in the UK or otherwise. These are what are called off-exchange dealing firms. They are companies that are set up for the purpose of making transactions for the retail trader. The retail trader, you at home, and so they are set up, and what they do is they take in bank feeds from potentially several banks, and these bank feeds will come in, and they'll show a combined approximate spot price. And then what the firms will do is they'll either use as close to or approximately that spot price and make their own accommodations for the price or adjust price accordingly based on what's happening within their client base or order flow base, or they will use the specific bank feed or multiple of bank feeds to determine the price at which they will offer to you, the retail trader. And that explains our off-exchange brokerage firms, which are called FCMs, Futures, Commissions, and Merchants, registered with the CFTC and members of the National Futures Association. What these off-exchange brokerage firms did to make the off-exchange dealing attractive was they changed the margin requirements, and now you can get margin of 100 to 1 or just 1%, sorry, 100% margin or 100 to 1 leverage. And now 1% permits you to make a deal. You only have to put up only $1,000 is required to trade $100,000 in the foreign exchange market, and of course you need $100,000 in the market in order to see any equity fluctuations in the account. The currency crosses, the four majors are effectively this: the euro, US dollar, pound dollar, dollar yen, and dollar Swiss franc. These are what are called the four majors. Now, when it's labeled like this, the euro, US dollar, the euro is the base currency and the US dollar is the cross currency. Okay? The British pound is the base currency, the US dollar is the cross currency. And you'll understand why this is important when we start to look at a chart to see what the reflection in price actually means. Here the US dollar is the base currency and the Japanese yen is the cross currency. Other instruments that you may be interested in trading are the dollar Canadian, the Aussie US dollar cross, and the New Zealand US dollar cross, as well as the Japanese yen accounts for the second largest amount of volume in the foreign exchange markets, and therefore some of the yen crosses can be good. The pound yen, euro yen crosses can also be good. Okay, euro yen, pound yen, and also the euro pound can be a good currency cross to trade. This chart here is just a reflection of the daily volume, and here we see during the Tokyo session, the majority of the volume generated is in the dollar-yen cross, secondly the euro-dollar cross, and then the euro-yen cross, thirdly euro-yen cross, and then some of the others. During the London, European, and New York sessions, we see primarily the euro-US dollar accounts for the majority of the transactions, the pound dollar, and then of course the dollar yen crosses, and then some of the smaller currencies, dollar franc, dollar Canadian, Aussie dollar, euro yen, and some of the others. And I'm just throwing these out just so that you can become familiar with just some of the terminology and some of the crosses that generate the larger volume. Are you a trader or an investor? Are you a consumer or a speculator? If you're a consumer, the way a consumer would trade is, let's say, for example, I have a portfolio of $1 million, and I have $1 million, and they're all in U.S. funds. Well, that would not be a wise or a prudent consumer decision, or a prudent consumer distribution of my portfolio, because I am exposed to major fluctuations in only the US dollar. And therefore, if the US dollar loses ground considerably against other major currencies, and I end up traveling or doing transactions in these other currencies, then I am exposed to considerable loss. Whether my investment is in US dollars, my house is in US dollars, or any other asset that I own are in US dollars, it's important to be diversified. You are a consumer making transactions in US dollars and holding US dollars, and therefore you are what's called a consumer. You can also be a speculator. A speculator is one whom, like ourselves, if we are trading in the intraday or medium-term or long-term foreign exchange markets, we can speculate on currency moves based on decisions that we've made, further based on our understanding of the technicals and the fundamentals of the overall the global markets, geopolitical environment, and our analysis, fundamental technical analysis. Therefore, we speculate and we make decisions and transactions based on our understanding that price could move from point A to point B, and therefore we would realize a profit from it, making us a speculator. So the difference between a consumer and a speculator, and you need to decide what you are and how to position your transactions accordingly based on these two categories. The consumer trader, of course, takes ownership or has ownership, and they also take delivery on the currency. So if I took 30% of my US dollars, I decided to move them into Japanese yen or euros, then I would take delivery on that currency and actually hold it in cash in an account in some instrument of some sort. If you're a speculator trader, you're just typically are individuals. They can be banks, and they can be dealt in cash or derivative instruments, options, swaps, forwards, futures contracts, etc. The largest speculators are corporations, hedge funds, and commercial transactions. CTAs are speculators, like myself. I'm a speculator, and our managed funds are done on speculation, with the hope of realizing a profit. It is foreign exchange market is a zero-sum game. One participant loses, another participant gains, and the loser pays the winner. Therefore, since we are dealing against a large number of very smart people and very well-educated people and people who understand the market, it is important that we ourselves should understand the market, and particularly from a technical level, which is where we're going to focus. However, we are going to also discuss the importance of the fundamentals and understanding the fundamentals in this market. A Forex broker, a brokerage agreement, when you open up an account, let me first give you an understanding. As a foreign exchange broker is again, these off-exchange firms that we deal through. You will enter into a brokerage agreement, and there will be a sizable risk disclosure document, and as well you'll be required to submit personal information based on if you're a U.S. citizen based on the Patriot Act, or if you're live in some other jurisdiction, then of course there are some Patriot Act principles that will also be implemented into what is required for you to disclose when you decide to open up an account. You will then deposit funds in this account. A lot of brokerage firms are solely foreign exchange brokerage firms these days. You can't trade through an investment firm, but you'll have to trade through either a foreign exchange brokerage firm or a futures brokerage firm that also offers a foreign exchange trading facility for the speculator trader. They'll give you 100-to-1 leverage and 1% margin in order to trade, to help you to pull funds out of the market with larger amounts of money. We are trading what's called one currency lot, and one lot equals $100,000, and that 100,000 US dollars is traded for another currency. The broker will hold 1% margin, so the broker will hold $1,000 or 100-to-1 leverage. They'll hold $1,000 while you have $100,000 working in the market for you. We are in the business of accumulating pips. One pip, if we have 1 penny, 1 US dollar cent, and we divide it into 100ths, then a 1 pip move equals 1/100th of a cent. Right? 1 pip value is approximately $10, depending on the cross that you're trading. And we'll get into that later. It's approximately $10 on a 100K lot. If it's a 10K lot or a $10,000 lot or mini lot, the pip value will be $1, 1/10 of 100K. Let's look at it graphically. If we buy, here we have a Euro-US dollar chart, and if we buy here at 119.30 and price moves all the way up within a couple of days to 121.30, we have made 200 pips. So 2 cents or 200 pips. 200 pips times $10 per pips using 100K lots is $2,000 because you had $100,000 in the market working for you. If you're trading a 10K lot or a mini lot, one 10K lot equals $1 per pip. So 200 pips times $1 would net you $200 on this currency move. In the foreign exchange market, we can equally go short. We're simply buying one currency or selling another, or selling one currency and buying another. So therefore, about 50% of your transactions will be long, and about 50% of your transactions will be short. Now, if we trade or if we sell short at 1.2400 on this euro-US dollar cross, we sell short at 1.2400, and price falls down to 1.2300. This has moved 100 pips, or 1 cent. Okay? 100 pips times $10. That's assuming you're trading a $100,000 lot. 100 pips times $10 equals $1,000. Now, if you're trading a $10,000 lot, then 1 pip equals $1. So 100 pips times $1 equals $100. This would be a $10,000 lot, is also called a mini lot. And therefore, $1 per pip times 100 pips equals $100.
Okay, so it's 10:03 right now, so that's all I got for today. I'm gonna be out of town this week in DC, so if you guys be patient, I'll be back Friday. We can do 2 more videos on Friday. If you got any questions, you know, hit me up. You guys know how to get in contact with me. You got my phone number, 910-524-9030, or, you know, if you want to email me or whatever, or hey, oh, we got a group chat, so yeah, any questions in group chat from anybody. Oh, I look tired, sorry. Anybody? Nobody? Is anybody still on the line? Did I lose y'all? Anybody there? Maybe, maybe not. Okay, well, if there are no questions, I will talk to y'all soon. Bye.